The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A range-bound stock market looking ahead to Nvidia for liberation. From Studio 2 here in Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele. We hope it's liberation because, man, it's boring out there.
Yeah, and everything is now weighted to what we might learn tomorrow night.
Exactly. Let's take a look at it here. It's all quiet pretty much anywhere you go. The S&P's up 0.1%. Volume, though, across the indices, incredibly light. And here's a quick, cross-asset check. When you're taking a look at the bond market, dollar, take a look at the VIX. It's just very, very calm right now. You did have a super solid 2-year auction, so you have yields down a little bit. But on the whole, we're all waiting for those numbers to cross Romaine tomorrow at 420.
Those numbers really reflected of the seesaw market that we've been seeing for some time. It continues for another day with that tug of war right now between the broad market bulls and the bears, pinning the S&P in a tight trading range. Again, a range that last week was the narrowest of the year. Investors still finding no consensus yet on whether the recent spate of corporate earnings, geopolitical developments, and economic data is enough to support further market gains.
We're still having the mother of all debates between the bulls and the bears. The bulls are being pragmatic and saying, look, earnings are growing 11% and rates are coming down. So those two things are pretty good for markets. And the bears are saying, well, the economy is slowing.
And that sentiment probably best reflected in money market tallies, which continue to swell to fresh records. Now, logically, it shouldn't make sense for investors to be sitting on $6.24 trillion in cash, given Jay Powell has now made clear that rates are indeed coming down. But for now, those super safe Treasury bills earning 5% remain that no-brainer trade, a trade Jeff Gundlach himself has dubbed T-bill and chill. So what, if anything, breaks this slumber? Well, look no further than the next 24 hours or so. A slew of earnings from economically sensitive companies like Nordstrom, Affirm, and Foot Locker that could certainly shift market sentiment. And then there's that $3 trillion elephant in the room, Alex. Nvidia, the chip maker, set to report earnings tomorrow after the bell. Anthony Sanglambeni over at Ameriprise said that could move the market more than Jay Powell himself.
Yeah, and there's a chart here that I have to prove that. So this comes from Cameron Kreis. He writes Macro Man column every morning. So just a little here what we have. This is the rolling 1-week impact of Nvidia on the returns of the S&P. And you can see how when we had the breakout of the AI chips back in 2023, the impact that Nvidia started to have on the S&P. Now, apparently, Nvidia now by itself is responsible for 1.16% rally in the S&P over the last week. Remember, it's 6.7% of the S&P. That's second only to Apple. So if we get a 9% move in Nvidia tomorrow on the upper downside, or on Thursday on the upper downside, that definitely has the impact to move the overall S&P by at least 0.6%. This could be that catalyst, Romaine, over the next couple days.
Yeah, potentially massive market moving event, and whether it changes the long-term outlook that folks have for this market remains to be seen. Let's get some insights out of Richard Weiss. He's the CIO of Multi-Asset Strategies at American Century Investments, joining us to kick us off to the close. And I want to get to the macro in a second, Rich, but we got to start off here with the elephant in the room, Nvidia. Its market weight, its just sort of influence, kind of all the space that it occupies in every investor's brain these days. How much are you going to pay attention to this tomorrow night?
Oh, there's no question Nvidia is a large part of market movements because of the representation it is in most indices and most people's portfolios, if they're indexed, that is. But I think the market's moving away from that. It's broadening out. There are a lot of other elements, macro and otherwise, we'll talk about. So we're not hyper-focused on Nvidia right now. That story arguably already peaking at this point, and we're looking beyond it to other sectors, to other elements of the AI story.
Well, let's talk about where those elements are, Rich, because that has been kind of the search now. I think a lot of people are in your camp that a lot of the juice in Nvidia has already been squeezed. Where else do you squeeze it? Where are those companies, those sectors?
Well, no question we're still in a bull market, right? But you see the significant sector rotation we've witnessed over the last month, 3 months. It's not tech and telecom per se, Mag 7 aside or Nvidia aside for the moment. It's financials, consumer staples, healthcare sectors, and even utilities. And what does that tell you? And the market's broadening out and moving to the more defensive, late cycle sectors preparing for what is a slowdown. So if we're in a bull market, this is the last legs of it. At least that's what the market's saying right now, and that's where we're looking.
So the cash that Romain was referring to, right, $6.24 trillion in money market funds, does that stay there then to stay defensive, or does that get redeployed?
Well, we would recommend you stay on the sideline a little longer, wait for perhaps a better entry point into equities at this point. We would not be diving into equities at this point, given the economic deceleration. I think most agree with, given where the manufacturing sector is, the housing sector, arguably, and the fact that Dr. Fed has to come in and give us more medication. I mean, that's not a good thing necessarily when the Fed has to come in and lower rates.
But that's such a great point, because are they coming in because of a recession and a material slowing, or are they coming in to normalize in a somewhat slowing?
A debate to be had, right? But either way, we'd say it's not necessarily great news. I mean, certainly they're coming in because the economy is slowing, labor market's weakening. Again, not a great thing to have more antibiotics or crack, if you will, for the market to move higher. And as far as normalization, I guess that gets us back to that elusive discussion of R star, the so-called neutral or natural rate of interest at which inflation and employment forces are balanced. Who knows where R star is, like the Where's Waldo of the financial industry.
Yeah, we haven't talked about R star in a while, Richard. For a while, I had actually given up my nightcaps before I went to bed, and I would just have my wife whisper R star in my ear, and I'd be out like a light. I am curious, where is that soft landing, Rich? Because when you listen to Jay Powell, and not just Jay Powell, but some of the other Fed members over the last 2 or 3 weeks, while they're not using the word soft landing, they certainly seem to be articulating that is what they, if not have achieved, or on their way to achieving. Do you buy that?
We're obviously hopeful we hit this softy-locks landing, as they're calling it. But given the significant perturbations, aberrations that came out of COVID, the supply chains, the inflation, which was not transitory by Chairman Powell's own admission and his fault in not recognizing that, the significant disturbances to the economy and the markets over the last 4 years, to bet solely on the fact that we're going to have this perfect landing, soft economy landing, not a high probability bet. It's certainly lower than 50-50. And that's why we're keeping the cash on the sideline at the margin and watching out for some more bumps in the road like we saw a month ago.
I am curious with that cash on the sideline, and this gets partly to what Alex was talking about a few minutes ago here. This idea that you have so much money sitting on the sidelines, if you will. Let's just take money markets as a proxy for that. Yeah, it's earning 5%, but we know yields are coming down. I mean, they've made that clear, and they're going to come down significantly here. So why aren't we seeing more people embrace longer duration, embrace a different part of the credit curve? What are they scared of right now?
Well, we are embracing longer duration, because if you expect a slowdown to any degree, those longer term yields should come down, giving you an extra bump in longer duration fixed income securities. I suspect folks are worried about the inflation front, right? If it does remain stubborn, it doesn't appear to right now. It has been coming down, but the monthly core run rates are still fluctuating around 0.2%, I believe, for CPI and PCE. That equates to roughly a 2.5% annualized inflation rate. That's not quite where the Fed wants it. We're not out of the woods on the inflation fight. Yeah. I suspect that may prevent some from going longer.
Hey, Rich, before I let you go, I get cash on the sidelines, wait to deploy like we saw about a month ago. What do you think we get next? Like, is it going to be another downdraft like we saw, that bout of volatility, something more sustained to the downside?
If we had a bet one way or the other, yeah, we're at least preparing for that risk and eventuality.
All right, Rich, always great stuff. Always wonderful to talk to you. Richard Weiss coming to us from across the coast, CIO of Multi-Asset Strategies with American Century Investments. As we kick you off to the close here on this Tuesday afternoon, where we see shares of stocks related to weight loss drugs other than Eli Lilly slimming down. This after the pharma giant announced that it would let patients buy single-dose vials of its GLP-1 drug directly. We're going to talk about the reaction across the sector.
All right, and shares of Hershey melting at this hour, while Citi is raising concerns about cocoa inflation and downgrading the stock to sell.
And Supermicro suffering the consequences of a short report. Hindenburg Research out with one saying that the tech darling has glaring accounting red flags. We're going to dive deeper into that and give you Supermicro's response. All that and more coming up in a bit. This is The Close on Bloomberg.
Eli Lilly taking its competition right now after the pharma giant announced it's selling Zepbound single-use vials priced at half of what its shots cost. The stock up almost 10%, 1/10%. Now the competition continuing to heat up in the GLP-1 space. Want to bring in Bloomberg's Madison Muller to discuss what it means for companies like Hims & Hers and Novo Nordisk. So this is just about making the GLP-1 drugs more accessible to people, which means you're going to jab it yourself. You're not going to wind up having that little cheaper jab thing. What are they trying to do? Are they trying to price out Hims & Hers? Are they trying to price out pharmaceutical compounds?
Yeah, I mean, it's threefold. So the first reason, I think, and maybe the most important reason is, as we've talked about, Lilly and Novo both have been struggling with supply because there's just so much demand for these products. For Lilly, part of the problem, or the main problem, is that the devices that they use to inject the drug are very complex to manufacture. So that sort of bottlenecks supply because they just can't make them fast enough to meet demand. So having these vials helps circumvent that. It makes it a little bit easier. It's cheaper to manufacture. It also helps with accessibility. It affords a cheaper option for people whose insurance does not cover these weight loss drugs. And it also helps sort of edge out these knockoff drugs, these compounders, companies like Hims & Hers that are offering cheaper versions of the drugs.
Is it going to do anything to their margins doing this since it's so much cheaper?
That's the question, is actually that because Lilly is offering, so they also offer a savings coupon. They've raised the price of that savings coupon at the same time that they're offering these discounted vials, which the vials, the net price of them, the revenue that Lilly's earning is actually pretty similar to the net price of the Zepbound shots. So the net price overall of Lilly's drugs is actually not changing that much, and analysts think that over time it could go up.
Why didn't they do this before?
There was some logistical things that I think that they needed to work out with third-party manufacturers, and just they've had actually the vials approved for a few months, so it seemed like it was maybe just working it out logistically.
So just remind me again, so companies like Hims & Hers, Roe, and a couple others that have been selling this stuff, and Weight Watchers is getting in on it, they're effectively relying on compounding pharmacies, whether they're compounding themselves or they're relying on a third party to do that.
Exactly.
They had an exemption to do that based on the idea that there wasn't enough supply of these drugs. Is that correct?
Right.
How does Lilly, and for that matter, Pfizer, producing the vials themselves, does that change how the government is going to classify whether these drugs are in short supply?
Right. I mean, that is the big question, and that's a big risk for these companies that a big part of their business right now is based on these knockoff drugs that can only be made when a drug is in shortage. Right now, Lilly and Novo's drugs are both considered to still be in shortage, even though all of the doses are available. But Lilly's CEO said that he sees this ending very soon. So that really is a big risk for these other companies. And they think, and they've said that they think there's still an exemption that will allow them to keep doing this, but we don't know.
I was on the website, though, and I noticed that some of these companies, they're also selling the branded versions as well. So even if they are not able to sell these sort of generic, quasi-generic knockoffs, are they still going to have a business? I mean, if they're able to sell Zepbound, I don't know what the cost structure is for them, but can they still be viable as a business?
Yeah, I mean, I think so. Some of the companies are not doing any of the branded drugs, partially because they were just so hard to find that they couldn't do that. So they went to these compounded ones instead. But most of the companies have said that once the supply gets better of the branded drugs, then they'll transition to that. So hopefully that gives them a little bit of a lifeline as the supply improves.
All right, Madison Muller, our chief GLP-1 reporter here at Bloomberg. A closer look here at the move by Lilly and, for that matter, Pfizer to now start producing, I guess, just the basic vials of this stuff, obviously to make it easier for people to get their hands on it. And you see the reaction in Hims shares down 8%.
Do you go through training to know how to load a syringe with liquid? That feels like that would be scary.
Yeah,
I'd be scared.
Yeah, I mean, I guess if you've never done it before, I
Right.
think the first time I ever had to do it, it was kind of like, how do I do this? And then once you do it, it's not that hard.
Okay, then you get used
I
to
mean,
it. Fine,
no offense to all the RNs out there, but it's like, once you've done it once, it's like, okay, it's not. It's just kind of that scariness of getting over the needle and
Yeah, that would be me
having
for
to do
sure.
yourself.
Yes.
But anyone who's had medical issues and had to treat themselves, we've been through this.
Okay,
So,
all right, fair enough.
All right, what's coming up? Well, let's go from weight loss drugs to talking about chocolate. How about that?
This is the point.
Analysts over at Citi not giving Hershey much of a break. We're going to discuss here a big downgrade today for the candy maker. That's coming up next, right here on The Close on Bloomberg. All right, let's get a view from the sell side. Our top calls, the big movers on the backup analyst recommendations, and we're going to start off today with PDD Holdings. This is the Chinese internet company responsible for all those commercials you've been seeing for that Temu shopping app. Benchmark cutting its price target on the company to 185 from 230. This after mixed quarterly earnings. The analyst, though, is still positive on PDD's fundamentals and says yesterday's 29% sell-off in the company's ADRs was a market overreaction. Nevertheless, the shares being bid down today by about 4%. Next up, let's take a look at Coca-Cola. Morgan Stanley lifting its price target to a street high $78 from $70 and replacing PepsiCo as the firm's top beverage pick. The analyst says Coke is posting healthier volume growth than its peers, a factor that's key for pricing power given instability in the broader beverage sector. Those shares up by about 0.8%. And we want to end things on a sweet note. Hershey, not so sweet. Citi kissing its neutral rating goodbye with a downgrade to sell, one of only 2 sell ratings now among the 27 analysts covering the stock. Citi citing volume weakness and cocoa price inflation amid more cost-conscious consumers that had already seen other snack categories lowering prices. Hershey's down about 2% on the day, and those are some of our top calls. We do want to say on that last call, though, pleased to say that the analyst behind it joins us now. Tom Palmer is Senior Equity Research Analyst over at Citi. And Tom, let's get right to it. I want to start first off with the price side of the equation, the cost side of the equation here, because you mentioned the increase that we had seen in cocoa prices and cocoa sourcing. Does Hershey not hedge for those types of price increases?
They do hedge for those increases, and that's some of why we're not going to, or Hershey's not going to need pricing until later this year to really address inflation. There is some this year, but the larger step up for them really starts to occur in the start of 2025. And that relates to cocoa futures really started to move earlier this year in kind of the April timeframe. And they've stayed elevated, but not to the same extent. So really what we're seeing this year is more of demand challenges starting to emerge in terms of volume. In response, some other categories, we should see more promotion, but for chocolate, because it is becoming so much more inflationary, you're seeing the opposite. And late this year, Hershey's going to be instituting price increases.
Well, talk a little bit more about that demand side, because when I hear like demand waning for chocolate, which for a lot of folks is probably goes into the same basket as, other consumer staples here, and particularly with a brand like Hershey's that I think would at least be on the more accessible and affordable side, what's gone wrong there? Where is that demand going?
It's really been one of the broader issues that we've seen across the snacking category, where snacking sales broadly have been weaker than we've seen for several years. There was a lot of pricing that flowed through really food broadly, right, in terms of the packaged food world, more so in snacking than many other areas. And we're starting to see the more severe elasticity. So food as a whole has been okay. There's been a shift more towards private label, more towards smaller brands that maybe didn't have the same supply chain issues that some larger brands had in terms of production for a couple of years. And now we're starting to see the other end of that, where these larger brands that took a lot of pricing are seeing outsized volume weakness, and snacking in particular.
Mm-hmm. And being in the chocolate business is tough. I mean, we saw Mars and Kellanova teaming up. I was joking around about it being a chocolate Cheez-It, right? I know you can't talk about that transaction, but I'm wondering for Hershey's, is M&A going to be a solution for them on this?
Their M&A focus in recent years has more been on the salty snack side, buying popcorn, buying their way into pretzels. And so it's possible that they continue to look in that direction. Hershey tends to be more conservative with its balance sheet. It targets leverage net debt to EBITDA below 2 turns. And so it really has been more incremental acquisition than so transformative historically.
When we take a look at the broader landscape, too, it's inflation, it's demand. We were just talking about GLP-1s in relation to Eli Lilly. The fear was that it was going to just crush the snack guys. Has it?
It's possible that is a small factor in terms of what we're seeing with volumes right now. But when we look at the adoption rate of GLP-1 drugs and the reduction in caloric content that follows, this is probably not the primary contributor today, although it is one piece of the overhang.
So when we talk about this idea here, I guess, of how if we are headed for maybe softer demand, less pricing power, and maybe potentially higher costs here, what can Hershey's do in that environment to adjust so that margins and the bottom line profits don't get hit as hard?
So the company's already begun to address this in some areas. It has 2 different cost savings programs. One is more of a productivity program aimed at reducing its cost of goods sold, and that's a 3-year program. And secondarily, it has another 3-year program to reduce SG&A by around $100 million a year. So those are 2 programs that are rolling out now. It also is targeting some innovation. We're seeing Shackalicious gummies coming out this month, so Shaquille O'Neal branded gummies, and there will be some other kind of more non-chocolate focused innovation, just given how chocolate's more of the pain point in terms of inflation.
All right, Tom, we're going to leave it there. Let's just say you definitely got my attention at Shackalicious. I did not know he had his own brand of gummies coming out, but I'll definitely look for them, and we'll definitely keep an eye out for your next report. Tom Palmer, analyst over at Citi. A downgrade today on Hershey's, though not totally bearish on the stock here, particularly with Shackalicious coming down the pipe. What's your favorite Hershey's product?
Oh. Okay.
Are you a chocolate person?
Okay, I'm a huge chocolate person, but as I age, I like dark chocolate. And dark chocolate's a harder mix to find. I am one of those people, but like in theory, it's a Reese's for me, but I like dark chocolate Reese's, and I also like Twizzlers. I know that's not chocolate. I'm a big Twizzler person.
Yeah, you lost me on dark chocolate. I feel like dark chocolate is just it's like broccoli. But Twizzlers, So I'm not a chocolate person, but I do like the gummy type of stuff. I guess Twizzlers falls into that category.
Totally does.
Too. So they have a lot of that. So they got some hedge here. They got that. I saw they got Bubble Yum, a few others, and I have no idea what the Shackalicious thing is.
So I think it's a gummy of his head. Which, like, if you want to eat his head as a gummy, okay.
Why not?
That seems like that's something, maybe, potentially. But either way, it does feel like the conversation around GLP-1s and the snack guys, has calmed down a little bit. Remember when, a year ago, it was all total panic?
Yeah.
I feel like it's a little bit more moderate at this point. All right, coming up, we're going to talk more about the Fed and how to position into a possible cut with Andrew Slimmon, Senior Portfolio Manager of Morgan Stanley Investment Management, about what's driving the equity market. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostic. Where was that guy going on that plane? I wish I was on that plane.
We are not on that plane. We are here in the studio, although it's my Friday today, so there is that. Market's going nowhere fast, volume light, equity moves not really happening, but yet you're still looking at about 4 rate cuts for this year. If you take a look at WARP, we have a great terminal chart that shows we're still looking at 4 cuts by the end of the year, which means that one of the meetings for the year has to be 50 basis points.
Is the Fed looking at 4 rate cuts for the year? I know the market is.
I mean, it doesn't really seem like it. It didn't seem like Jay Powell set us up on any kind of path or a big cut in September. Mary Daly spoke with Mike McKee yesterday, and she definitely laid the groundwork for a cut. But again, nothing jumbo.
Well, to my mind, we've been on this path of ready to adjust policy rates for several months. We just needed to get a little more confidence that inflation was truly on its path to 2%. And I wanted to see the labor market come into balance, but I think that's completely happened. And the risks to our goals are now balanced, and the time to adjust policy is upon us.
Adjust, Romaine, does not feel 50 to me at the end of the day. Andrew Slimmon is Senior Portfolio Manager and Head of Applied Equity Advisors at Morgan Stanley Investment Management. Andrew, good to see you. Are you expecting 75 for this year or 100? And does it actually matter in how you're going to allocate in equities?
Well, I think it matters because there's a huge amount of money sitting in money markets. It's been the fastest growing asset the last year has been money market funds, and understandable because rates are very high. So it matters because the speed with which they cut rates is going to cause money markets to become less and less attractive. And could that be actually, the gasoline that accelerates the market, as rates drop, say, below 4% early next year? I think that could be a big driver. So, yeah, the speed with which they cut is going to, be directly linked to how fast money comes out of money markets.
Why are we so convinced that that's actually going to happen? Like, why can't the money just stay there?
Well, because I think just two reasons. Number one is, unfortunately, investors look backwards to frame their viewpoints on investing. And so 5% in the money market looks attractive when the year 2022 of a bear market is still in the rearview mirror. But now we've got 2023, which was a good year for equities, and also now 2024, good year for equities. And suddenly you have a combination of returns for equities is far better than money market, and the yields on the money market's going to go down. So unfortunately, Alex, it's human nature to chase into better returning, especially when rates aren't as attractive. So I think that's what, that's normal, and that's probably what will happen at some point late this year, early next.
Yeah, I mean, at some point we're definitely going to get there, particularly if rates do come down as much as the market thinks they will be. Before we get there, though, Andrew, there is a big question here as to who is willing to embrace the equity market right now at current valuations, given what we know about the economy, given what we know out of this past earnings season.
Yeah, I think that's fair. And a couple things. Number one is, I think the S&P has fully reflected the Fed beginning to cut rates. But I think that's why you're seeing a rotation into other areas of the market, like the S&P equal weighted, like the interest rate sensitive stocks, utilities, REITs are doing better, small caps. And with the dollar weakened, I wouldn't be surprised if international markets do better. So I think the large caps have priced in the rate cuts, but I'm not sure other parts of the equity market have as much.
Are we looking at that proverbial soft landing that I know we had all kind of embraced a couple of years ago when this rate cycle started? Is that still a realistic outcome?
Well, I think it is, but it worries me, Romaine, that so many people now expect it. And we've just had this V rally, we went 5670 to 5100 back to 5600 awfully quickly. And it's this expectation of everything's, the soft landing and lower inflation. So could that thesis be challenged in September? I think it's very possible. What worries me is the number one buyer of stocks, and I don't think this gets enough interest, the number one buyer of stocks is corporate buybacks. Mm-hmm. They were big, very aggressive buyers when the market sold off in August, but the window closes because it's coming up to third quarter earnings in the second half of September for over 50% of the corporate buybacks. So they're not going to be buying back stock at a time when seasonally the second half of September is a very bad time of the year, right when the Fed begins to cut rates. I just worry that a lot of good news to your question is priced in short term, and could we have a hiccup that cause, who knows, maybe inflation print is a little higher, or the economic data comes in a little weaker. That's the type of thing that could cause, a pullback.
A hiccup, is it going to be like what we saw in the beginning of August, that kind of hiccup, or something more severe, or just a bump?
Well, I don't, I think we're going to have a fourth quarter rally. I expect the market will end the year closer to 6,000 because I don't see the corporate earnings story as weak. And that's kept me very grounded the last couple of years in avoiding kind of all the worries of the bear market. Has been this continuation of earnings estimate revisions, especially for next year, going up. And that's what's so important, because on December 31st of this year, we're going to be pricing off 2025 earnings estimates. And right now, the bottoms up is $279 or so. So that's what analysts have been guided to by companies, is $279 a share. But top down, Wall Street is much lower in the 260 range. So I think just like last year, you're going to see a lot of strategists be forced to raise their earnings outlooks for next year. And so I do think fourth quarter will be strong, but could we retest that 5,100? I would be surprised. But I do think there is that commonality, is usually when you have an earthquake, there are tremors after, and boy, we haven't seen one yet.
All right. Always great to talk to you, Andrew. Andrew Slimmon there, head of Applied Equity Advisors at Morgan Stanley Investment Management, and I'm told a lover of dark chocolate.
Yeah, see?
Yes, so you found your kinfolk there. I am curious though what he's saying too about the fourth quarter though too, because there's been a lot of concern, particularly with an election, obviously not full clarity on what the Fed's going to do, just how much of a tailwind equities will have heading into that fourth quarter.
Yeah, I just don't know how you manage that with the election volatility. And usually going into it's a not misnomer, but then afterwards it's going to be about high tax companies, low tax companies, different sectors, and how you manage that. Also, keep in mind that after the election in 2020, the sectors you thought were going to do well didn't. And the sectors like energy you thought were going to tank didn't. So I don't know how that's like a sustainable bet.
And this is why you see so many advisors say don't trade elections, because you'll probably get it wrong.
Yeah.
There's probably a few people that are smart enough to really hit it. The rest of us, I don't know.
I'm definitely not. That's why I sit here.
All right, coming up here, we're going to take a look at some of the other big stocks moving here on the day. Hindenburg Research out with another short report, and this time it's targeting one of the darlings in the AI space, Super Microcomputer. It's our stock of the hour, and it's coming up next. This is Bloomberg. All right, time now for our stock of the hour, a closer look at Super Micro. Hindenburg putting out a short report accusing the company of accounting manipulation. Super Micro has responded only to say that it does not comment on rumors and speculation. Nevertheless, the report did drive the shares down now by about 2%. Bloomberg Intelligence analyst Jin Ho joining us here in Studio 2 to talk a little bit more about this. And let's just kind of get to the heart of what the report was getting at. It raised some issues about customer concentration, third-party transactions, as well as some sort of temporary delisting that Supermicro had back in 2019. Is that pretty much the entirety of the substance of this report?
Well, I think there was some of it is raising some yellow flags in terms of accounting manipulation as well. And that was probably the biggest yellow flag there, but a lot of that was hearsay as part of that report. I will tell you a lot of the, concerns that Hindenburg raised was principally on past issues, things that were already in the 10Q and 10K filings. Mm-hmm. The delisting, as you said, was a 2019 issue, right? And now they resolved the SEC issue and is relisted in the S&P 500.
And I should point out, a lot of the stuff was quoted from your research because you were pouring through the 10Qs and 10Ks and pulled out some stuff that made you a little bit worried.
Yeah, and we flagged a lot of these risk factors in our report. And essentially, we're talking about the customer concentration, also the gross margin issues as a potential risk, related party issues. That's, in the risk factors in the 10Q and 10K as well.
So I am curious. I mean, obviously, we heard Supermicro's response, which was basically no response.
Yep.
Was there any sense, at least in what you saw in the Hindenburg report, that any of those issues are still ongoing?
No, nothing that I can see, right? I almost felt as if Hindenburg came in, they were kicking a company again when it was already down because of how much the stock has pulled back because of the gross margin challenges off of recent reports. And it seems as if they're coming back with, regurgitating some issues from the past.
What is interesting is that Supermicro went from being a small cap company to being in the S&P because of its super strong rally. So I'm wondering if there was also a lot more scrutiny now because it's in the S&P.
And I agree with you there, right? So if we look at the company, a small cap management team has a small cap infrastructure, and now with the S&P 500, you're getting a lot of scrutiny not only from broader investors was also from the sell side. We're talking about tier 2, tier 3 shops covering the company at first, and now we're talking about the bulge brackets taking a closer look at it, and institutions taking a closer looking at the stock. So, they're putting a lot of great scrutiny on the name right now.
Yeah, stock down now about 45% from its high back in March. I am curious, too, as we're talking about kind of the broader AI space. Of course, Supermicro kind of became the darling when people figured out there was other companies out there other than Nvidia that were benefiting from the AI race. Of course, we hear from Nvidia tomorrow. I know you don't necessarily cover that directly, but you know this space. And, of course, you know what the end customers are doing or maybe not doing here. Are you excited to see this report tomorrow, or are you kind of approaching it maybe with a little trepidation?
Well, let's see what happens with the AI frenzy. I think it's going to be a validation of the AI frenzy.
You do? Okay.
In terms of NVIDIA, right? We all know about the Blackwell delays. The next generation chip pushed out to December or January. And let's see if it does hurt the outlook. But all indications say, going back to Supermicro, they raised their guidance relative to consensus. So it seems as if the Blackwell delays may not hurt NVIDIA as much as one may fear.
All right, we would really appreciate it. Busy week for you also. He covers NetApp, HPE, HPQ. He's a busy man. Jin Ho of Bloomberg Intelligence. Thank you very much. But I guess the question is, even if they beat Romaine, is that going to be enough to move the stock? Remember last quarter, it just kind of treaded water for a little bit.
I've been asking people this question because I was like, what would that beat look like? And I think part of it is going to be an articulation of the long-term growth. If they can do that, maybe the stock rallies. If they don't, who knows?
We'll break it down more. We're 15 minutes to the closing bell. Shelby McFaddin is up next. This is Bloomberg.
This is the countdown to the close. Just about 10 minutes until we get to those bells, Alex Steele. We talk about sort of a market that I guess is waiting for something because they're certainly not doing anything right now.
I mean, I'm off tomorrow, but I really hope that you guys get some action because this is just pitiful at the end of the day. Volume super light, nothing happening. Russell, though, the Russell 2000 is off the lows this session, only down 0.5%. Nvidia getting a little bit of a boost into those numbers tomorrow. Yeah, definitely some action, Jackson, tomorrow here. And I was looking at the options market a little bit earlier. Of course, the consensus is right now that the up or down move on Nvidia alone could be in the double-digit percentage range, and given its weight in the markets, that could move the market up or down by 1% or more. Here to talk about some of those market moves and some of the things driving them is Shelby McFaddin, here to count us down to those closing bells, just about 9 minutes away. She's a senior analyst with Motley Asset Management and joins us here in New York in Studio 2. We're going to get to Nvidia in a second. That, of course, is the elephant in the room. But we forget there are a lot of other earnings actually coming out this week. In fact, tonight we're supposed to hear from Nordstrom. There are actually quite a few other retailers reporting this week, Chewy and Best Buy, Foot Locker, a bunch of other ones, Burlington that I'm forgetting. Obviously, our main interest in those right now is trying to get a handle on how healthy the consumer is. Are we spending? And if so, what are we spending on? Are you walking into these earnings that we're about to get over the next 24, 48 hours optimistic, or are you a little bit worried?
I think I have a sort of a cautious optimism. And part of that is because each of these companies are run by different management teams. And that does affect the strategy first, and how the strategy plays out is also going to determine the results. So when we looked a couple of weeks ago and we looked at Walmart and their primary competitor reporting, we thought there'd be a bit more of a chasm. And there was a gap, but not quite as much because management started making different decisions. When we're looking at this group coming up next, we've got luxury, so we've got Nordstrom, we've got something a little bit niche in pet care, so they have to take a different strategy to what it means to grow and to stabilize for them. And then we have discount stores. So not only are we looking at really 3 different branches, we're looking at different management teams. So I think there's a sort of element of surprise within each one of them, and we'll be able to kind of dissect what the consumer is more cautious on versus not.
You guys over there are pretty much more or less bottom-up fundamental type investors. When you look, but you of course have to have an eye on economic conditions, macro. When you look at the health of the consumer here, is this something that's going to be widespread, whether the consumer's healthy or whether they're not? Is that a widespread effect, or as you're getting at here, when you're talking about kind of the idiosyncratic nature of management here, are we going to see benefits or obviously detriment to specific companies or sectors, and if so, where?
I think we're sort of beyond the point now where we get that widespread detriment. I think we saw a lot of that earlier on when inflation was really, really harsh. And now it's coming down to certain brands, certain retailers and whatnot. So when we look at it from a portfolio management perspective, it's more of an allocation issue. So we're not going to, completely sell out of those positions. We're just going to tweak what percentage they are in the portfolio, in accordance with the extra risk that comes along with the macro conditions that we cannot control. So I wouldn't expect it to sort of be a wildfire type of effect, be a little bit more condensed.
So what do you like in the consumer space?
In consumer space, I mean, two names we've always loved are going to be Walmart and Costco, right? And that's not surprising, but it's because of what they deliver. Quarter after quarter, they're able to go ahead and capture higher income households higher up the income schedule. And then we had with Costco a month or so ago increasing their membership finally, so that was a huge deal. Yeah.
But you guys also own Starbucks.
We do.
Talking about discretionary, like my $7 coffee thing, like that's gonna be the first thing to go when things get tough.
And it's interesting that you bring that up because that's a great case for active management. We watch it like a hawk. It's not a passive watch for us. We have seen that management transition coming in, and it's not just a great celebration of great, we're done as shareholders, this is going to be fantastic. It's been said you can't cost cut your way to victory, right? So there's more than just slimming down the fat. There's a lot that has to be done on culture there as well. And Starbucks has a massive market share, the biggest global market share in coffee. So it's an opportunity we have to at least continue to watch.
What did you think when you heard Brian Niccol was going to take over? I mean, obviously he is pretty much the rock star CEO, other than Jensen Huang. He's probably the rock star CEO out there, a guy who turned around Chipotle, turned around Yum Brands, or Taco Bell. What exactly was your reaction when you heard that he was going to Starbucks?
I think as a team, our first reaction was, as I said, this will be great for shareholders, right? We know that they are going to probably focus on finding ways to improve that bottom line. But we also know that one of the major complaints has been the sort of lack of identity for what is the Starbucks brand and who is the Starbucks customer. And then a lot of disgruntled customers and definitely a disgruntled labor force. So when we're looking at quality, we do consider these things. How happy is management? How happy is the culture? And so that's going to be a task that he has to be up to as well.
Let's talk tech here, because we're going to get Nvidia tomorrow. We also get Salesforce, a few other tech companies as well. Do you find a lot attractive in this space, particularly given some of the valuations?
I would say when we think directly in the mega cap tech, that is not necessarily our favorite space. We do have some positions there, but it's more so in sometimes smalls that are in sort of niche software platform spaces that may be in insurance or in advertising, retail tech, things like that. Primarily because of the valuation, so we're not necessarily adding to those positions. But yes, there is the argument that there is a tremendous amount of opportunity simply because of how much data gets to be leveraged. And we're entering a time where if you are too mature to start leveraging your data, you will be left behind.
Do you feel, when do we think we're going to know how cyclical AI chips are?
I think when it comes to chips, the bigger factors are the materials, and knowing when those shortages are going to come around is not quite as easy as following the business cycle.
So not the demand side, but the supply side.
Well, that's part of it. And then the demand side, I think, tips off if investors essentially say, where are these projects going? So if we follow the chain, if we start all the way at the end with one of the hyperscalers with these massive cloud platforms, and we go all the way back to the ASML, what is driving ASML is whether or not the hyperscalers are going through with these projects at the end of the day. If those projects start to condense, if investors are not happy with the returns, if management has said this is not delivering, then that's when you start to see a sort of scale back. But that doesn't necessarily follow our normal business cycle. So it's a different sort of cyclicality. The cycle is how long investors are willing to tolerate these proposed return on investments.
All right, so now this is time for the really hard question here,
right.
Shelby. So if you're on a desert island, and the only thing you have to eat is Twizzlers, gummy candies, and a pound of dark chocolate, what are you choosing?
All right, health benefits, dark chocolate, antioxidants, right?
Right.
But just because I want to, Twizzlers. It's the best road trip food.
There you go.
Yeah.
We're debating like gummies.
Is it gummy candy?
I'm dark chocolate, he's a gummy, and I don't understand. I'm like, what is this?
Well, congratulations. You're the tiebreaker. Twizzlers wins. Sorry,
pleasure.
Alex, you lose. Shelby, always a pleasure to have you. And not for your candy knowledge, but of course your investing knowledge. Shelby McFaddin, she's a senior analyst with Motley Fool Asset Management, counting us down to those closing bells that are just about 2 minutes away. Stick with us. A lot going on in the markets over the next 24 hours. We're going to have a big breakdown of what to expect right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, alongside Alex Dark Chocolate Steele, and here to help take you through the closing bell. It's a global simulcast. It starts right now. Scarlet Fu, of course, Titanium member over at Costco. Tim Stenovic, who I don't think is a member of anything, and Carol Massar, of course.
They don't know what you're talking about.
I like it better when they don't know what I'm talking about, because then you get the crazy reactions out of Carol Massar.
Speaking of not knowing what you're talking about, I have some breaking news here.
What's that?
Carol has no idea who Oasis is.
What? Neither did Quinette, our senior producer. I don't understand.
Where were you in the mid-90s, guys?
I'll be on any team with Quinette.
Where Carol was.
I even sang it in our meeting today.
Champagne Supernova. I sang some Wonderwall earlier on air, and I never sing anything because was that such a loss?
Tim hummed a few bars. I have no idea what that was.
Oh my God, Carol!
Can you believe this?
Come on!
Don't look back in anger. Come on.
They were supposed to be bigger than the Beatles,
but
they
not
weren't.
Bigger than the Beatles.
Carol.
They're not. They're not bigger than the Beatles.
I mean,
come on now.
Well, anytime you have to declare that you're going to be bigger than the Beatles, you're not going to be bigger than the Beatles.
I mean, please. They're not bigger than the Beatles, but still.
What did the Beatles sing?
All the songs. I want to hold your hand. Okay. Anyway, this conversation. This conversation perfectly exemplifies what's happening in the market. Nothing.
Well done.
Absolutely nothing at the end of the day.
Would everybody just come back from their beach houses and vacation so that most red could be something different?
They will. They will tomorrow at 4:21 p.m.
And then they'll go away again.
All right. Well, you are seeing a lot of action today in the options market. That's not necessarily feeding through to the cash market in equities, as a lot of people are sitting on their hands right now till we get those big earnings, of course, out of none other than Nvidia tomorrow after the bell. As for today, you're looking at a market that's relatively unchanged. A Dow Jones Industrial Average up by about 10 points here. The S&P up by 9 points, or about 0.2%. The Nasdaq higher by the same amount on a percentage basis. And the Russell 2000, that's your primary laggard of the day, down about 15 points, or 0.7%.
All right, back to the S&P 500 I go. Kind of an even split, you guys. 242 names in the S&P 500 gaining ground. Scarlett, 259 to the downside, 2 unchanged.
Okay, the IMAP is really unexciting. You take a look and, yeah, I know. There's green, then there's red. There's more green, admittedly, because tech is the best performer, up 0.6%, followed by financials and REITs. And then in terms of decliners, you have energy, because oil prices declined, Alex. Utilities lower by 0.75%, and consumer discretionary also lower by about 0.5%. Ho-hum.
Ho-hum is right. All right, so let's go to some of the individual gainers, if we may. Insulet, POTD, POD is the ticker. Stock up about 6.6%. Medical device company announced that their Omnipod 5 received FDA clearance for people with type 2 diabetes aged 18 years and older. Our own BI industry team and analysts saying that this clearance unlocks an additional 6 million U.S. patients, which is nearly a 4-fold gain. So you can understand maybe why investors are sitting up and taking notice. Another one kind of in this space, I feel like, ResMed, up more than 7%. It was the number one gainer in the S&P 500 today, highest intraday since August of 2022. William Blair saying the breathing machine maker now views the GLP-1 weight loss drug impact to be a tailwind on its sleep apnea and CPAP business versus management's original view last year of a neutral impact. So that's kind of, I know, it's kind of a Netflix was a top gainer in the NASDAQ 100. Evercore ISI analyst Mark Mahaney coming out, raising the firm's price target to $750 from $710, keeping an outperform rating on the shares. They've done some channel checks, and they continue to see mid-single-digit percentage upside to the streets. Fiscal year 25 EPS, with even further upside if Netflix returns to its historical price increase cadence. So that went up 1.2%. One last one for all you tea drinkers out there. Hain Celestial up almost 20% in today's session after the company's fiscal fourth quarter organic sales declined less than Wall Street had expected. Keep in mind the stock's still down more than 20% year to date. Still don't know who Oasis is.
Okay. So I can't help you there. I will.
You tried, Tim. You tried.
I tried. And she's an Apple Music person. I'm a Spotify person, so I can't send her even Spotify links. So yeah, we're having issues here.
We'll be doing some Googling tonight.
Supermicrocomputer is my decliner of 3, one of the 3, down 2.6% today. They fell after Hindenburg came out and said it's short SMCI. The stock fell as much as 8.7%. It did pair some of those losses just to close lower than 2%. Hindenburg did write that an investigation into the company revealed, quote, glaring accounting red flags, evidence of undisclosed related party transactions, sanctions and export control failures, and customer issues. A spokesperson for Supermicro said the company, quote, does not comment on rumors and speculation. And Kava Group, I was doing gainers while Carol was gone Friday and Monday. Kava was on my list of gainers those days. Now it's on my list of decliners, down 6%. It did fall as much as 9.5% after the company's largest individual shareholder and a group of executives filed to sell shares. Ended up closing down by just about 6%. And Hims and Hers Health, it's the telehealth platform. It fell today by 7.5%. Remember, the company's been selling compounded semaglutide to treat obesity, but shares fell after Lilly came out and said self-pay patients could now buy these single-dose vials of its own weight loss drug, Zepbound.
All right, taking a look at the bond market, guys. Yes, okay, kind of a snoozer, but we had a 2-year auction of $69 billion and actually went pretty well. There was some strong indirect bidding, and you see a little bit of a bid into the bond market, and the 2-year yield's down by 3 basis points. And we do get supply, guys, over the next couple days. We get the 5-year tomorrow, $70 billion, and the 7-year on Thursday, $44 billion. So this could actually move some stuff.
All right, speaking of moving, we talk about a lot of the financial types heading to Florida, the Miami area, and so on. Well, it seems like soccer continuing to build out its hub in a big way, expanding kind of their FIFA presence, and that includes the president, Tim.
Yeah, headed to Miami. They're gearing up for the 2026 World Cup. It's going to include matches in Miami, but also 15 other cities in the U.S., Mexico, and Canada. Their footprint expands and bolsters Miami's standing as a global soccer hub. Of course, we can't talk about this without talking about superstar Lionel Messi, who led Argentina to victory in the 2022 tournament.
And there he is in his best-selling pink jersey as well. Yeah, that may be the case, but Miami needs to do a better job with managing game day. Remember what happened when Colombia played, I forget which team, but it was kind of a disaster with all these people trying to rush the stadium, and it delayed the game for the Latin America World Cup.
All right, Nordstrom's out with earnings. Just taking a look at adjusted earnings per share. A nice beat there at 96 cents. Also, their full-year adjusted outlook also to the high end. At the most, they see about $2.05, and the low end, $1.75. And also, their total revenue for the second quarter also pretty strong, $3.89 billion. The anniversary sale was what everyone was really watching here for Nordstrom sales.
Yeah, it's kind of interesting, too. We talk about a 3.4% jump in sales, but as always, a lot of that growth is coming from the Nordstrom Rack brand. So you did have a beat on net sales there. The Nordstrom brand itself, the flagship brand, the revenue there, while higher, coming in below what the street was looking for.
Yeah, interesting. This is one that's really shown some outperformance this year, up about 15%, though, as they go through some of their changes, and you're seeing it build on that, up about 1.7%. But we'll see what it says in terms of tone about consumer going forward. I'm curious to see what they say in terms of commentary on the call.
Yeah, Alex, you mentioned the anniversary sale. They said that the one day that fell in the third quarter, the top growing categories were beauty, active, and home at that anniversary sale. Eric Nordstrom also said that they're confident in the outlook for the remainder of the year and look forward to sustaining the momentum we built as we execute our 2024 priorities. Active, women's apparel, beauty, and kids had the strongest growth versus last year.
Do these results quiet all the talk about maybe the family taking Nordstrom private again, or someone else coming in and buying Nordstrom? Because fact of the matter is, young people do not go to department stores. We all know what the Nordstrom anniversary sale is, but try as they might, even on TikTok, it's not necessarily gaining a lot of traction.
But I gotta say, for Nordstrom Rack, though, those places are packed. Have you guys been? And net sales there increased over 8%. Comp sales were up by about 4.1%. So I hear you that the anniversary sale is super important, etc. But their Nordstrom Rack is really crushing it also.
Yeah, absolutely. Here, I was kind of, we're going to keep an eye here on those numbers here as Nordstrom shares continue to move higher in after-hours trading. There was a story that I was keeping an eye on, and this involved Pizza Hut. A bit of a gimmick here, but they've actually created, and I don't know if we have a picture of this, a pizza box that actually converts into a coffee table. This is basically some Cosmo Kramer type stuff going on here. Basically, they're basically saying, look, when you move into a new place, what do? You order pizza, but you got no furniture, right? Everything's still packed up, everything's in boxes. So why not have the pizza box double as a coffee table?
Can I keep it for a few days?
I think you can keep it forever, Tim, and you put it right in front of your TV set, and you can watch all the Oasis videos that you want.
Can I get eggplant on the top of it? That's all I want to know.
Yeah, but doesn't like the oil come and like seep through the box?
That's what I was thinking.
A topping.
Alex, the cardboard kind of gets ruined after the pizza's delivered, right?
Yeah, and then it collapses, the oil's gross. You know what I'm talking about?
All true. All good points.
Then you can compost it.
It's like going back to college.
Maybe that's what it's for.
Just saying.
Which was kind of during Oasis, right?
But you know what? If you read the press release until the very end, it's only available in the most popular U.S. cities to move to: Dallas, Charlotte, and Orlando. So it's not available to us in New York, unfortunately.
Well, there's no room for these coffee tables.
Well, I mean, who eats Pizza Hut in New York?
I can't wait for all the Instagram pictures of people in their homes with their Pizza Hut.
I'm sure that's what
By
they're
the way,
thinking
before
of.
you say goodbye, Carol, and I know you like long goodbyes, I just want to point out Oasis has sold more than 70 million albums. According to Wikipedia, it's probably the most influential British rock band since, guess who? The Beatles.
I don't know.
I even saw them.
There you have it.
She doesn't buy
I saw
it.
an Oasis concert in 2000.
This is why they broke up, Carol, because of
I'm probably
you.
going to own a Pizza Hut table before I own one of their albums. No, I don't.
You don't have to own an album. Just recognize one of their songs. That's what we're going to work on.
All right, I'm going to go home.
I'm coming over to your desk after this,
I'm
Carol.
going to go home and I'm going to listen to a song. I'm like, oh my God, I love that song.
Yes, that will absolutely happen.
Chabellas. All right, that's a wrap. Our cross-platform, radio, TV, YouTube,
I don't get Carol.
and...
Do you get Carol? Yeah.
All right, Alex, we'll see you later. We know Scarlett and Romain are continuing on TV, and we're going to do something over here. Maybe listen to a little Oasis on Bloomberg
There you go.
Radio. See you tomorrow, guys.
All right, stick with us. Our coverage does continue on Bloomberg Television. Earnings coming fast and furious once again here in the after-hour trade, including out of Nordstrom. Zachary Waring, equity analyst over at CFRA, going to be joining the big program in a second. This is Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romain Bostic. Scarlett, a lot has changed over the last few sessions here in the market. And today, well, actually not much change here. Basically unchanged on the day across the board. Modest gains, if you will. 0.2% on the S&P 500. Similar moves that we saw on the NASDAQ and the Dow. A bit of a holding pattern for this market right now, of course, as it awaits results out of one of the biggest companies in the world, Nvidia. Take a look, though, at the two next lines here. You saw the Russell 2000 negatives move a little bit lower here on the day. Some concerns here about economic conditions. Meanwhile, you saw a huge rally actually in the cruise ship space here on the day. This is partly on the back of those earnings we got out of Viking. They weren't actually fantastic, but they did provide some long-term guidance that helped to lift the broader sector here. And then that big three-day rally that we had in crude, giving back a lot of that today, down about 2% here on the day, Scarlett.
All right, so let's focus on a couple of individual movers that are nowhere near the size of Nvidia, which reports tomorrow. Hain Celestial Group was the best performer in the Russell 2000, gaining almost 19%, climbing the most in 21 years. And this is after the packaged food company posted a smaller than expected drop in organic sales. And its forecasts, according to analysts, were better than feared. The forecast was for flat organic sales this year and mid-single digit EBITDA growth. So that's the new reason to bid a stock higher. Paramount Global, one of the worst performers in the S&P 500, losing more than 7% on the day. Seagram heir Edgar Bronfman Jr. dropped out of a bidding war for the media company. And the reason reportedly is because of the process's tight deadline. Remember, he came in at the very end of the go-shop period for Paramount after it had agreed in principle to the bid from Skydance, which is run by David Ellison. That deal, by the way, with Skydance is expected to be closed next year. That's another reason why the Edgar Bronfman bid did not go through. Romain?
All right, we do want to go back to Nordstrom. Those shares are continuing to move higher, up about 10% here in after-hours trade. Revenue growth, which actually has been a rarity for this company, but now 3 straight quarters of revenue growth, roughly up about 3% in the quarter here, with, again, a lot of those gains coming from the strength of the Nordstrom rack discount brand. Zach Waring joining us right now, equity analyst over at CFRA, to talk a little bit more about the results. $3.89 billion in revenue, 96 cents in adjusted EPS, a beat on both of those metrics here. Are you happy with that beat, Zach?
Yeah, I think this is a pretty good quarter. No, they did have a benefit of their anniversary sale. So last year, 8 of the days of the anniversary sale was slid into Q3, so next quarter, whereas this year only 1 day was slid to Q3. So they had a pretty big boost from that. And then they have obviously been opening a lot of those rack stores over the course of the year, with plans to open more in the fall. But yeah, it's a pretty good quarter. I think a lot of it does have to do with those new store openings and the timing shift of the anniversary sale.
Well, let's talk a little bit about longer-term growth here. I mean, this is a company that's obviously been struggling a little bit to continue that pace of growth, coming off of a last fiscal year where we saw revenue down 6%. It looks like this fiscal year, I should say, is going to shape up to be a bit of a turnaround here with positive revenue growth here. Do you see that continuing out beyond fiscal 2025?
I do think they'll have some momentum going into next year, just because they're opening, like I said, all these rack stores. But after that, I still think they're facing some long-term headwinds. Their larger store, just the Nordstrom banner, has had some struggle with growth, and like I said, they're opening these new stores, which has kind of boosted the sales growth this year, and I think that'll last a little bit into next year. But I think overall, long term, they're still battling those department store headwinds.
We were talking earlier about Nordstrom Rack and how it's always crowded. And of course, it's a bit of a treasure hunt to try to find a great deal. To what extent does Nordstrom Rack steal sales from the Nordstrom Popper?
I think a little bit, but I would say, yeah, those are a little bit outdated items. Usually those are, last year's model of whatever it may be. So I think they're a little bit of diversification for them. Whereas their Nordstrom store is typically this year's model of apparel and footwear. So, I think they do cannibalize a little bit. I think really who they're fighting with the rack store is TJ Maxx and Ross. Mm-hmm. So, we still like those two over Nordstrom because we think that's the pure play, and that's really benefiting right now.
You mentioned the long-term headwinds facing department stores as a sector. What is Nordstrom's point of distinction from Macy's, from Bloomingdale's, from all the other department stores and the headwinds that they face? What makes it stand out?
Yeah, they do cater to typically a little bit higher end consumer, but they really don't have much else in differentiation. They've really pivoted to this, discount rack store, which, now they have almost 270 of those rack stores. Compared to under 100 of their typical Nordstrom banner store. So they've really pivoted to that discount store. And I think that's kind of the only difference between them and some of these other department stores.
Hey, Zach, I know you also cover PVH, of course, the parent company of Calvin Klein and Tommy Hilfiger. Those earnings just now crossing the wire. We should point out for our viewers, adjusted EPS in the most recent quarter coming in at about $3.01. The street was looking for $2.29. Revenue came in line with estimates at about $2.1 billion. But the guidance, though, not looking good here. The company's saying the full year revenue will be down 6 to 7% here, also providing an EPS forecast that is well below street estimates, $2.50 a share on an adjusted basis for the current quarter. The street was looking for $3.12. Zach, you're still with us here, and I know you haven't had really much time to actually parse these numbers, but I'm wondering if you could just kind of give us some broad strokes outlook as to sort of what you want to see out of some of these apparel companies that maybe are dealing with a consumer that's being a little bit more picky, and more importantly, also dealing with end suppliers, meaning their retail partners, that might also be a bit more cost and inventory conscious.
Yeah, I think you kind of made a good point there towards the end. I think the biggest thing is managing inventories better. You saw that kind of get out of hand during the pandemic. And I think now that's the big focus is efficiency, inventory management, and really trying to grow margins in any way they can, which, in the U.S. is a little bit more difficult as wages have kind of increased over the last few years. But they've been benefiting this year from those lower freight costs and supply chain costs. So, I expect going into 2025, you're going to kind of get away from those freight tailwinds that they've had and the lower input cost tailwinds that they've had. And so now you're really going to, find out who's the cream of the crop, who can really manage those costs and still, attempt to grow revenues in North America and then globally.
All right, Zach, really appreciate your joining us. Zach Waring is equity analyst over at CFRA. Let's stay with PVH here and bring in Bloomberg Intelligence's Mary Ross Gilbert for a little more context on these results. And Mary, what got my attention when it comes to PVH overall is that it has not reported a sales increase since third quarter of 2024, but earnings per share has actually been growing at double-digit percentages during that time. Put that together, what is PVH's playbook exactly?
Yeah, so Scarlett, what's happening here with PVH, first of all, just to kind of go over the numbers that you guys talked about, their earnings per share came in above expectations. They actually raised their guidance for EPS, and they affirmed their guidance for the full year. But there's also some noise in there, too, because they did sell off a business last year, and that's going to be about a 200 basis point impact. So when they say down 6 to 7%, 200 basis points is the sale of that business. And then there's another 100 basis points for the extra week. So then the decrease doesn't look so alarming. And what we're still parsing through the numbers because they just literally dropped the numbers a little bit late after the close. But what we have been seeing is strength in DTC, North America and Asia, weakness in Europe. And Europe, it's really due to one, weakness in that market generally, but also a reset of that business. So they're purposely exiting some of the wholesale business there, and also on the online, they're exiting certain third-party sites. So we're expecting a decrease this year in Europe, but then next year they could get a lift.
I am curious, though, but just before you move on that point, because when you go through the numbers here, Mary, it's very obvious that some of the sales weakness overall for the company was directly tied to the international business, and the breakdown they give shows that. Plus signs for North America, minus signs for international. If that is all coming from Europe, you're saying that this was part of the strategy with their exiting of the businesses? That's why we're seeing those negative signs?
Part of the reason, I would say a majority of the reason for Europe. Yeah, for the Europe part of international. And actually, if you look at, I don't see the Asia numbers yet, but they were up earlier, in the first quarter. So I'm assuming they're probably up. But look, Europe is almost half the business. Asia is about 18%. The U.S. is only about 30% of the business, just to give some context there. And where we're seeing the weakness on the Europe side is mostly in the Tommy Hilfiger business, where they're exiting certain business, not on the Calvin Klein side. So if you look at Calvin Klein International, it was down. It was basically sort of flat on a constant currency basis. We think that's a better measure for the business. And that compares to Tommy Hilfiger down 5% on a constant FX basis. And of course, we're sort of expecting that weakness there. But the big piece of the story, Romaine, is that next year they have a license rolling off for women's, for both brands, Calvin Klein for the U.S. wholesale business, actually for North America. That starts to roll off beginning next year. It sort of happens this year, but next year they could get $300 million lift in that wholesale North American business. And over the next 4 years, that total annual revenue lift could be $1.1 billion. So something that isn't really focused on because we're kind of focused on one quarter.
All right, Mary, always great to talk to you. Mary Ross Gilbert over at Bloomberg Intelligence, a breakdown of some of the results we got just out of PVH as well as Nordstrom, too.
All right, coming up, we've got the top three, where we focus in on some movers and shakers at the center of the day's biggest stories. And Romaine, don't look back in anger. That's our hint.
Oh, okay.
We don't normally do hints for this, but I just figured I'd throw it in there in case Carol Masser's watching. This is the close on Bloomberg. It's time now for the top three, where we name drop some of the people driving the day's most talked about stories. And first up is Oasis, the 90s Brit-pop band made up of feuding brothers Liam and Noel Gallagher.
Yes.
The band is back together, Romaine, for the first time in 15 years. They're reuniting for a tour next summer.
Yeah, even if you don't like Oasis, even if you don't know their music, just the drama around this family and these brothers over the years. So to see them back together and performing, we're going to have to get some tickets for Carol Masser and introduce her to one of the biggest British bands in the modern era. Excuse me. All right, we will keep an eye on Oasis. We're also keeping an eye on two people that, I don't know, personally I'm kind of tired of, but Travis and Jason Kelce are going to be around for quite some time because they just signed a $100 million 3-year deal with Amazon's Wondery for their podcast. Everyone's getting paid off these podcasts. I think it was it last week or the week before, we were talking about the woman who runs Call Your Daddy, and now the Kelce's. And obviously it's a natural fit, I mean, given just how big Travis has gotten, of course, because of his very famous girlfriend. But they were already doing this even before he started dating.
They were doing it before he started dating Taylor Swift, but because of her, the listenership took off, and now they have the 14th most popular podcast in America.
What episode do you think Taylor Swift is going to show up on? Because
she
has to show up now, right?
Well, the podcast is no longer about football analysis. It's moved on. It's about the culture at large, right?
Yeah, I think it would be great if there's just like all the guests are just Taylor Swift and her friends.
Then it would really be number one.
Yeah.
All right, finally, Leonard Riggio, the founder of Barnes & Noble, has died. He turned a single store into a book superstore, complete with coffee shops, reading nooks, music, and gift departments. Some stores were 60,000 square feet.
Yeah, I mean, to say that he was a pioneer in this space, and of course, someone who was often criticized for the empire he built, but an empire that stands the test of time. All right, well, as a lot of investors right now are trying to parse, well, the tea leaves when it comes to the economy and to corporate earnings, they also have to keep their eye on the political and election cycle. Early polling in the U.S. election cycle has traders already adjusting their investment strategies. Democratic Party candidate Vice President Kamala Harris keeps rising in the polls against the Republican pick, former President Donald Trump. And that shift in polling is now actually starting to show up in the market as traders try to reposition themselves around more short-term volatility. Pleased to say joining the program right now is Tina Byles Williams. She's the CEO, CIO, and founder of Xponance, and she joins us today from beautiful Philadelphia. All right, Tina, we talk about a market that I always feel like maybe they shouldn't be trading around the election, but everyone's kind of on edge. So whether you're trying to make a bet on the outcome or you're simply trying to, position around the volatility that's usually accompanied by that, do you think that this election cycle for investors is going to be different than what we saw in the past few U.S. presidential cycles?
So one of the truisms of every election cycle is that both candidates are constrained essentially by, the preferences of median voters, the sort of zeitgeist, if you will, of the time. And the zeitgeist is essentially driven by mostly a millennial or Gen X, Gen Zer. And if you look at few polls, they've been turned off by the core tenets of neoliberal orthodoxy, such as hyperglobalization, fiscal, restraint. Mm-hmm. And so, so whether it's Harris or Trump, what you won't see is any attempt at fiscal austerity. You will see protectionism ramp up. What will differ is, what sectors benefit for Trump. You're probably looking more at industrials, real estate with Harris, right? Healthcare, probably utilities. And the other sort of underappreciated change is with Trump, he has sort of expressed, let's say, cynicism with respect to federal institutions, including the Fed, which obviously is more important for markets. Yeah. And that's where I think that's the underappreciated change.
Well, Tina, can we go back, though, to something you just said, and that was really about on the deficit and debt issues, because this has come up a lot during this cycle. And look, I feel like every few years we as a nation have this conversation about our debt and deficit and then actually don't do anything about it. Am I supposed to believe, though, that this time, particularly amongst Wall Street and investors, that they are taking this much more seriously now, or is this just going to kind of fade away once we get past November?
The federal budget deficit is 7% of GDP, and rising interest rates are already squeezing out other types of expenditures. I don't hear from either platform a solid plan for reducing the deficit. The CBO expects that the primary budget deficit will shrink by 0.8% in 2025, but that also assumes that the Trump tax cuts will sunset next year. Obviously, Trump has already said that he will push to not do that. Right. So Harris, on the other hand, has sort of, proposed an expansion of tax credits and essentially the social program, but she's also proposed that the corporate tax rate be raised to 28%.
Yes.
And raise the rate on capital gains. So I would say that's a neutral.
So, Tina, one thing that we've seen in 2024, which is a big year for elections around the globe, you had Mexico, India, the UK, France, is that markets were often surprised. Is there any reason to believe, based on the reactions we saw with some of those elections, that we might get a surprise here in any way in terms of market reaction?
So one of the common themes, underlying themes of pretty much all of those elections is that they've all been, people are hankering for change. Mm-hmm. I mean, even those incumbents that hung on, like Modi, survived, or Cyril Ramaphosa in South Africa survived severely weakened. So you kind of say, well, who is the change candidate here? Is it Trump? I don't know. Not so much. We've obviously had a President Trump before and Harris. So I don't know. It's a little, it's not clear cut, but there is clearly a hankering for change.
All right, good stuff. Tina, really appreciate your time joining us today, giving us a glimpse into how she's thinking about the election and investing. Tina Byles Williams, CEO and founder of Xponance. We have some breaking news. The NFL owners held a meeting today. It was an unexpectedly short meeting. It was an unexpected meeting in that Roger Goodell announced it with not a whole lot of notice, but the owners have approved private equity ownership up 10%. So they've now approved that private equity can buy 10% of a team. The owners have approved 3 PE firms, Arctos, Ares, and Sixth Street, to invest in these teams. And of course, there are 32 teams remaining. We know the valuations of these teams have just gone up, and up. And when valuations go up, institutional investors take notice, and they're in a position to raise a lot of money.
And not only take notice, but it also becomes an issue of who can afford to buy these teams anymore. As they get bigger, at some point, maybe you have to start dividing up that pie. And I think that's potentially the role that some of these PE firms and their limited partners will play.
All right, let's just take a look at what also happened in trading today. The answer is not a whole lot. You had the S&P 500 gain just marginally. Everyone's really waiting for Nvidia tomorrow after the market closes. And then after that, we have some eco data at the end of the week, and then jobs report next Friday.
Who's your favorite football team?
The 49ers.
I think I know that. San Francisco.
Yeah.
That's like the dark chocolate of football.
Yeah. That's like the Yankees of baseball, I feel like. The 2-year yield moving down slightly because you had a $69 billion 2-year auction, which went off okay, and oil prices down 2%, giving back a bit of the gains that we saw the last 3 days. This is The Close on Bloomberg. All right, we want to give you another update on that breaking news that we just told you about. NFL team owners have voted to allow private equity firms to buy stakes in their franchises. This is a big move that had been talked about for years, and it has finally happened. This, of course, is happening as valuations of these teams continue to rise. Here in studio with more is David Abrams. He is founding and managing partner at Velocity Capital Management. Velocity invests in intellectual property across sports, media, and entertainment, so he's very familiar with this space. David, great to see you.
Great to be here. Thanks for having me again.
So we mentioned how this has been on the agenda for years. They've talked about it, but they didn't actually vote on anything until now. It feels like it's taken them longer than maybe you would have thought, given that the NBA, European football, has done this a while ago. Why do you think there's been hesitation, and why are they moving forward now?
Well, you're right. The NFL is the last major sports league in the world to allow private equity to invest. I think it's a combination of a couple of factors. First of all, a lot of the NFL teams have been owned by families for a long time. And so, my experience, when you bring in third-party investors with a professional sports team, it really is a family business and, more importantly, a community asset. Mm-hmm. So I think the NFL did a lot of work on trying to figure out if they were going to allow private equity and what would be the governance around the capital and the best way to do it such that, one, it helped increase franchise values, but more importantly, was good for the fans.
It's good for the fans. So talk a little bit more about that. What does having institutional investors' money in a team allow the franchises to do that they can't do at the moment?
Well, with any professional sports franchise today, it's really all about the fan experience. And what you're seeing is ownership groups and leagues trying to figure out the best way to increase the experience both in venue and when they are focusing on just buying tickets, buying sponsorships. It really is a key right now to drive revenues and increase fan experience. And think about the NFL, they've got the largest global media rights deal. So clearly they have fan base all over the world, and they want to understand how do they reach that fan base, and more importantly, how do they commercialize their intellectual property.
So by bringing in these investors, though, there's been a lot of talk about how this is going to make things, the relationship even more financial. I mean, we've kind of joked in the past about a lot of the smaller partners that come into these teams. They're kind of there for the glory, right? It's kind of a trophy. You just want to be able to say, I own, even if it's like 1%, of the Commanders or the Jets or whoever. Well, not the Jets suck, but anyone else, the Bears. I mean, it's facts. But anyway, the point is by having investors that maybe don't have an affinity specifically for the team itself, meaning the actual what happens on the field, is that going to put more pressure and maybe even create more turnover when it comes to the executive ranks of these teams and even things like the coaching ranks?
Right. Well, when you think about private equity, the premise is to try and make a business more valuable and function better, right? And a lot of sports teams have been run as more family-oriented organizations, and so they don't have best practices. By bringing in private equity, you're going to, one, improve the overall senior leadership team. Second, you're going to focus on performance both on and off the field. And the most important part of any professional sports team is your interaction with your fans and in the community. And so by bringing a new voice in, creating proper governance, getting people around the table that have done this in other sports and other markets, I think it's a great thing for the NFL, and it's been long overdue.
Once we start to see the effects of this, and if they are indeed positive, do you anticipate that 10% cap would be raised?
Well, the 10% cap for NFL teams, while it might seem like it's a small number, the valuation of NFL teams is the highest versus any other league in the world. So it still is a very large capital commitment for funds. And as it relates to sovereign wealth funds, which were not part of the original group here, I think it's important to note of the three firms that were given the ability to invest in NFL teams, they probably all have sovereign wealth funds as their limited partners. So indirectly, you're getting a lot of excess capital coming to invest in NFL teams.
And we should mention that the three firms that were approved were Arctos Partners, Ares Management, and Sixth Street Partners. I know that you can't name names, but what kinds of teams do you think are obvious candidates for outside capital to come in and make a difference?
I think the teams that would be looking for capital first and foremost are the ones that have large expansion projects that have probably been put on hold because they couldn't get money either from their local municipality or they didn't have the capital themselves. So what you're seeing is, one of our portfolio companies works directly with the Tennessee Titans, right? It's a multi-billion-dollar project that takes several years. And so if you are an owner now and you can sell a stake in your team, you can invest not just in your stadium, you can invest in your practice facility and really improve that fan experience, which drives revenues, and that's really what this is all about, right? The more sustainable the revenue streams, the easier it is to attract third-party capital like private equity.
But will having this third-party capital, these institutional investors, make it easier for teams to threaten to leave a city if they don't get what they want from the municipalities and the taxpayers? I mean, they can just say, you're not giving us the stadium that we wanted, so we're going to pick up and move to the neighboring state.
I think most owners of professional sports teams recognize the relationship with the community. And the only reason to have left in the past was you needed funding from an organization to increase your overall value of your team. And if you have third-party capital coming in today, there really shouldn't be a reason to leave. I mean, there have been instances, obviously, with teams leaving cities, but now you're probably going to have a little bit more expansion in a couple of the major leagues. So cities that have lost teams before have the opportunity to get them back. But I don't think this is going to be any kind of catalyst for a team to try and, quote unquote, threaten to leave because there's no reason now they can access capital as before they had to get capital from another city. Now they can access from their investor base.
All right, Dan. David, great stuff. Great to have you here. David Abrams, he's the founding and managing partner over at Velocity Capital Market. Of course, talking about the story that just crossed the Bloomberg terminal a few minutes ago. The NFL now allowing private equity ownership of its teams, of course, capped at 10% each here. But at least you got three companies coming out of the gate that will be able to participate.
Yeah, absolutely. Arctos Partners, Ares Management, and Sixth Street Partners, they were pre-approved, and then you also have a consortium comprised of Dynasty Equity, Blackstone, Carlyle, and CVC Capital Partners, some of the biggest names in private equity now able to buy into the NFL.
And I have a feeling that list could even grow longer over the years here as this experiment, I guess, officially begins. Stick with us here on The Close. Scarlett and I coming back after the break, setting you up for the potential market-moving events over the next 24 hours. This is The Close on Bloomberg. All right, stocks right now, they were struggling for direction today, and a big part of the reason is they want more clarity and they want it out of Nvidia. By tomorrow, around this time, we will have the latest quarterly results for what has been, of course, one of the best performing stocks of the last couple of years. The chip giant now, at least for right now, is up about 150% year to date, and its quarterly release is expected to move the market in a big way, up or down, no matter what that release says. Matt Bryson joining us right now is the Senior Vice President of Equity Research and Analyst over at Wedbush Securities. And let's just start off here with your expectations of what we hear tomorrow. We know there's going to be revenue growth, Matt. How big will it be?
Yeah, so I'm in print suggesting that Nvidia can do about $30 billion in the quarter reporting, can guide to about $32 billion. So, about $4 billion in growth Q on Q.
Of course, this is a company where nobody's really looking or too concerned about the current quarter or even the next quarter. This is a stock right now, at least on a valuation basis, that is priced for the future here. When you look at current valuations and the reports that we've gotten so far out of Nvidia, do you think that that valuation is justified?
I do. So last time I downgraded Nvidia, I downgraded it because it was trading at 50 times out year numbers, and that really isn't something we haven't seen since the days of Cisco. Now, I think as long as Nvidia continues on its current cadence, where the last few quarters they've been giving us almost $4 billion in sequential growth, and I think they're able to sustain that type of growth through the launch of their next chip, Blackwell. That really even brings kind of my numbers up because I don't have that fully baked into assumptions. And I think you end up with Nvidia ultimately trading at something close to, say, 30 times, which is where it's been the last couple of years.
Matt, have you heard anything from its customers or its suppliers to suggest that Nvidia won't deliver exactly the kind of consistent outperformance it's managed to do the last couple of quarters?
Certainly not in the quarter they're reporting or their quarter they're guiding to. So you look at the supply chain out of Taiwan, they saw, I believe, an uptick in Nvidia requirements in the May-June timeframe, and that was requirements for the second half of this year. If you talk to the ODMs, they all have very optimistic outlooks for the back half of this year. If you talk to the server makers, or you look at what the server makers have reported, I mean, Supermicro, they just gave us a quarter where they grew by well over $1 billion, guided for well over $1 billion in growth. So NVIDIA's customers look really strong. Suppliers make it sound like things are really good. So no, at least I'm not running into any concerns, certainly not around the next couple of quarters.
Got it. Okay. So you mentioned Blackwell, the new chip. NVIDIA's commentary around Blackwell is going to be critical for sentiment and how investors perceive the rest of the sector. What could they say in terms of disappointing investors that could have people rethinking some of their thesis around the space?
Yeah, so I think one of the reasons that NVIDIA was lagging earlier this month and in July were concerns that Blackwell was delayed. Certainly at this point, it does look like Blackwell was pushed a bit. Different reports that suggest anywhere from a few weeks to a few months. I think it's important that NVIDIA management give investors some confidence that any delays are relatively modest, that they understand what the reasons for the push were, and they're confident that Blackwell comes out in a timely fashion. And I think as long as the delay is a few weeks, a couple months, that there's so much demand for their current generation products, Hopper, lid. You really don't see any impact on results.
So you're not concerned at all, Matt, just to be clear, on corporate spending, the idea that some of that corporate spending that we've seen in this AI space, not all to Nvidia, but overall, could potentially be scaled back just a little bit?
So on the hyperscale front, I think that at this point, everyone is making a bet that the next wave of applications is going to be built on AI. And we've seen them spend more and more money consistently on that thesis. And I think until we get the next wave of models out, so ChatGPT 5, until we see Blackwell get into data centers, so people spend on the next generation of hardware and see what it brings, I don't think anyone's going to move away from those bets. There's just too much revenue at risk.
All right, Matt, really appreciate your joining us. Matt Bryson is SVP of Equity Research and Analyst at Wedbush Securities. Of course, Nvidia will be reporting tomorrow, and be sure to stay tuned for Bloomberg's extensive reporting of those results, starting with special coverage on Bloomberg Technology, including a live interview with Nvidia co-founder and CEO Jensen Huang. That will be at 6:30 p.m. New York time tomorrow.
All right, that's going to be one of the big market moving events, but it's not all out there that could potentially move the market. We set you up for what to watch in the pre-market with some earnings out of quite a few retailers.
Yeah, Foot Locker among them. So that's an interesting read on names like Nike and Reebok. Chewy, the pet retailer, Bath & Body Works, Abercrombie & Fitch has become like the darling company
again. It's a huge turnaround over there. And how many companies, CEOs have you heard saying they're actually looking to what they did in Abercrombie and saying, can we replicate that, that Gap and some of these other companies that have also struggled? We also get Kohl's as well as J.M. Smucker. But let's go to the after hours, of course. We know Nvidia, that's the big one. But there's a couple other ones that are going to get lost in all that. I thought it was interesting, Salesforce is scheduled to report. And we know they tend to have a huge market impact as well.
Yeah, especially with a lot of activist investors still keeping an eye on that name. Victoria's Secret, which of course has a new CEO. We're going to hear from them as well. And CrowdStrike, after enduring some of the issues that they had.
Yeah, we got a read on the fintech sector out of a firm, a read, of course, on computers, personal computers, if you will, out of HP Inc. and quite a few others as well. But of course, the market still has their eye on the macro, and we get more Fed speak tomorrow.
Well, we have one Fed speaker tomorrow, and that'll be Bostic. I was going to say Romaine Bostic, but it's the other Bostic.
Yeah, the less handsome Bostic.
He's speaking tomorrow at 6 p.m. with the Stanford Club of Georgia in Atlanta.
All right, of course, we will have full coverage of all of those events. Thanks for joining us here on The Close. Stick around. Balance of Power coming up next, right here on Bloomberg.